You're sitting at an airport gate with your backpack on your knees, half listening to a boarding announcement you've already heard twice. Your laptop is open on the little tray table. An email slides in, Weekly Portfolio Health Report. It's from the new Agent your brokerage rolled out, the one that promises to monitor everything for you. You click. A clean PDF appears with green check marks, a confidence score, and 3 suggested actions. The language is calm, decisive, and oddly personal. We recommend rebalancing today to reduce risk. Your foot starts tapping without permission. Your mouth goes dry. You scroll to the bottom and see a button that says, Approve All. For a second, it feels irresponsible not to. Here's the invisible script. The more you outsource judgment to confident tools, the more you quietly pay a biastax. Small decision leaks that drain outcomes even when your returns look fine. In this video, I'll show you 9 mindset traps that collect that tax and the simple proof objects that help you spot them before they become habits. I'm Mr. B. I'm fascinated by money, obsessed with financial psychology, and with the weird gap between what we intend to do and what we actually do when the screen is glowing. In a moment, I'm going to give you a 1-page bias-proof journal and a decision support system that make these traps visible without needing you to be disciplined all the time. Think of your investing life like a small ship. You can have a solid destination and a strong engine, but if there are tiny seams in the hull, water gets in. Not in one dramatic wave, through pinhole leaks you barely notice. The bias tax is the waterline creeping up while you're busy arguing about the weather. In 2026-style investing environments, AI summaries, auto trades, non-stop feeds are designed to feel helpful. The problem is that helpful can also be persuasive. So instead of starting with bias names, I want to start with mechanisms and artifacts. The things you can actually point to. Let's make the tax concrete with a short illustrative audit. Imagine a $50,000 portfolio. Now imagine 2 sources of leakage that rarely feel dramatic. One is implementation drag, small fees, spreads, and friction that add up. The other is behavior drag, tiny timing mistakes made for emotional relief, chasing, hesitating, selling to stop the discomfort, buying back to stop the regret. If those leaks total about 1.5% a year, that's $750 per year on $50,000. Over 10 years ignoring compounding, that's $7,500 that quietly left your future. The headline metric you celebrate is return. The metric that changes your outcome is the bias tax you pay through leakage. Now, where does that tax get collected? 9 places. 9 traps. Each one comes with a proof object, an artifact you can draw on a piece of paper, and a felt experience you'll recognize. Trap 1 is automation bias, and in 2026, it often wears the costume of Agentic finance. The artifact is that Approve All button under a confident report. The micro scenarios are mundane. You're tired after work, you skim the summary instead of the details, and you approve because the tool sounds calmer than you feel. Or you see a risk-reduced badge and take it as truth. The dialogue is simple. If it's optimized, it must be safer. Your brain buys it because outsourcing uncertainty feels like protection. Felt truth. You're being prudent. Structural truth. You're defaulting into decisions you didn't fully make. That gap is the first collector of the bias tax. Trap 2 is outcome bias, judging a process by the last result. The artifact is a screenshot of a green month, saved like a trophy. The micro scenarios, you made a concentrated bet and it worked, so you repeat it. You confuse a lucky streak with a repeatable edge. You start trusting whatever you did most recently because it got rewarded. The dialogue, see, I knew it. Felt truth, skill, structural truth, reward conditioning. The bias tax shows up when the market pays you once, and your brain turns that payment into a permanent rule. Trap 3 is the concentration trap, and it's amplified by winner-takes-all narratives, especially around technologies that seem inevitable. The artifact is a portfolio pie chart with one slice so big, it looks like a decision, not an allocation. Micro scenarios, You keep adding to the same winner because it's emotionally easier than admitting you're unsure. You stop stress testing the thesis because it's obviously the future. You ignore new information that would force you to update. The dialogue. I'm not diversified, I'm focused. Felt truth, conviction. Structural truth, dependence. This is where the ship stops being managed and starts being attached to one story. An attachment is expensive when the story changes. Trap 4 is recency bias, the time horizon collapse. The artifact is your notification stack. Earnings alerts, breaking banners, someone's hot take, a chart that flickers red, then green. Micro scenarios. You check in the grocery line, thumbs scrolling while a cartwheel squeaks. You read a headline in the last 5 minutes of your day when your brain is lowest power. You treat fresh information as more important than relevant information. Dialogue. I just want to stay informed. Felt truth, responsible. Structural truth, your horizon quietly shrinks to whatever just happened. The bias tax is paid in rushed changes that your long-term self didn't request. Trap 5 is loss aversion, which often creates zombie portfolios, positions that are technically alive but psychologically dead. The artifact is the break-even line, written like a finish line. Micro scenarios, you refuse to sell because realizing the loss would feel like admitting a personal flaw. You avoid opening the app because the red number feels like judgment. You tell yourself you'll deal with it later, and later becomes the strategy. Dialogue. It'll come back. Felt truth, patience. Structural truth, regret avoidance. That leak is sticky because it lives in identity, not spreadsheets. Trap 6 is FOMO and herding, and the artifact is social proof on demand. Group chats, comment sections, and 100 people saying the same thing with a confidence they didn't earn. Micro scenarios, you buy because being late feels worse than being wrong. You hold because exiting would separate you from the crowd. You measure your plan against other people's timelines. Dialogue, everyone's in this. Felt truth, safety. Structural truth, you're borrowing conviction from strangers, and borrowed conviction becomes panic when the lenders leave. Trap 7 is confirmation bias, the echo chamber that looks like research. The artifact is a folder of saved posts that all agree with your thesis. Micro scenarios. You search for supportive takes and call it diligence. You dismiss disconfirming evidence as noise. You curate your inputs until uncertainty disappears. Dialogue. I've done my homework. Felt truth, rigor. Structural truth, selective exposure. The bias tax here is subtle. You stop paying attention to the one kind of information that could actually protect you, information that would change your mind. Trap 8 is hindsight bias, rewriting uncertainty into inevitability after the fact. The artifact is the chart you scroll back through, pointing at the obvious moment. Micro scenarios. You tell yourself you knew it, so you become more aggressive next time. You punish yourself for not acting on clarity that didn't exist. You start believing you can predict because you can explain. Dialogue. I saw it coming. Felt truth, mastery. Structural truth, memory editing. Explanations can feel like foresight, and that feeling can push you into risks your real accuracy can't support. Trap 9 is anchoring, being stuck to an old price or an old regime. The artifact is a sticky note with a target price you wrote months ago, treated like a law. Micro scenarios. You refuse to buy because it's too high compared to an old reference point. You refuse to sell because it's down from where it was. You keep evaluating today with yesterday's ruler. Dialogue. I'll wait until it gets back. Felt truth, discipline. Structural truth, reference point lock-in. The bias tax is the opportunity cost of being faithful to a number that no longer deserves authority. Here's a clarifying line. None of these traps require you to be irrational. They require you to be human in an environment that's optimized to feel certain, urgent, and social. Now, the practical question: how do you reduce the bias tax without trying to become a flawless robot? Start with a bias-proof investment journal. Not a diary, a one-page decision log. 3 boxes. First, what did I do? Second, what was I trying to feel? Relief, certainty, belonging, control. Third, what evidence would have changed my mind? That last box is an escape hatch from confirmation, hindsight, and anchoring, because it forces you to name the missing information before you act. And then add a decision support system. Again, not advice, just an educational template you can adapt. Think of it as 3 gates between impulse and action. Gate 1 is the probability gate. Is this a forecast or a story? If it's a story, write the uncertainty down in plain language. Gate 2 is the process gate. Would I make the same decision if I couldn't see today's price chart? That separates outcome worship from repeatable behavior. Gate 3 is the position gate. If this went against me for a while, would future me still have options? That protects you from concentration comfort turning into concentration captivity. Notice what's happening. The ship metaphor evolves. At first, it's mechanics, pinholes in the hull. Now it becomes identity. Are you the captain making decisions by policy, or a passenger reacting to alarms? And then it becomes optionality. You don't need perfect forecasts. You need a ship that stays seaworthy long enough for time to matter. One more contrast that's worth holding on to. The screen sells you the feeling of control, but the structure often removes your control by shrinking your horizon. The feed sells you certainty, but the structure increases your confidence without increasing your accuracy. And the crowd sells you safety, but the structure makes you fragile, because your conviction depends on other people staying convinced. If you take nothing else, take this. The bias tax is not paid in one dramatic mistake. It's paid in tiny, repeated leaks, especially on tired days, lonely days, and high-emotion days. So the next time that Approve All button appears, don't argue with the market. Inspect the ship. Ask, which leak is trying to open right now? Automation, outcome worship, concentration comfort, recency fog, loss glue, herding, confirmation, hindsight, or anchoring. If you like this style of calm investing psychology, mechanisms, artifacts, and honest self-audits, subscribe to Mindfolio, and I'll see you in the next video.